Well, welcome to another episode of Finance Uncut, where we talk everything finance and economics with an Austrian flavour. On today's episode, I want to explore, is Warren Buffett betting on inflation? Well, coming in from CCN, not CNN, legendary investors are bracing for high inflation, and so should you. Investors like Warren Buffett and Ray Dalio are tweaking their portfolios to battle high inflation. You should consider following their lead. Legendary investor Warren Buffett and Bridgewater Associates founder Ray Dalio are hedging against inflation. And yes, they are. We'll have a look at that. More stimulus packages will add to the national debt as the Federal Reserve steps in to monetize the debt by printing more currency, not money. Inflation will rise rapidly. The time is right for retail investors to follow Buffett and Dalio's lead and brace themselves for rapidly rising prices. Well, yes, in a way yes, and in a way no. So when the Federal Reserve, they actually don't print money, or they don't even print currency. They print bank reserves. And so when they're buying government bonds, when they're buying mortgage-backed securities or any other assets, it's basically a swap. They from the dealer banks and sometimes the commercial banks, hedge funds and other financial institutions, and it's really like a swap. So they buy those assets, those bonds from the dealer banks, and in return they give them bank reserves. Now those bank reserves are held at the Fed. They actually don't get out into the real economy. They're just there as reserves or collateral for the banks to create new loans, because in our economy, we are a debt-based economy. Our monetary system is a debt-based monetary system, and so we create debt, which in terms is money, or it's currency, but people think it's money. And so when you create more currency, create more loans, you're actually creating inflation, and higher prices is just a result. But also the other way is true. When you pay down debt or pay back debt, you are destroying currency, which is deflation. And so the Fed doesn't simply print money or currency. However, when the federal government are running huge deficits, and those deficits are going to consumers in the form of stimulus checks, UBI, you name it, and effectively the Fed is kind of monetizing that debt. So yes, at the treasury auctions, both international investors, but the dealer banks will go there pretty much on behalf of the Fed, buy those assets, buy those government bonds, and then straight away sell them to the Fed for a fee, and they get those bank reserves. But we do know that the banks aren't lending; they're not creating new currency. So from the traditional way of things, no, there's no inflation going on. But through the government actually handing funds out to people, then there's more currency. So we see the M2 money supply growing. Now, you can look at that one or two ways. Some people look at it as, well, it's savings, so it's not being spent, it's not going into the economy, and that is true. However, it is new money that's sitting in there, so it does depend what the people do with that money. So we saw, over the last 4 or 5 months, people opening up retail accounts, retail trading accounts, and speculating. Small retail investors speculating in particular in the NASDAQ, in the FANG stocks. And so they've used those funds to then spend on that particular asset class, if you want to call it that. And we've seen inflation rising there. We have seen people paying off credit cards, and we have seen, in Australia anyway, savings go up to almost 20%. I think it's about 18 or 19%, down up from usually about 6 point something. So people are definitely saving. The question is, does that money or does that currency come out soon and start buying goods and services and other things? I have my own theory on whether we're going to see inflation or deflation, and perhaps in another video I can explain more as to my theory behind that. But anyway, let's read on. So I'll just disappear myself here. Recently, Warren Buffett dumped US banks and gained exposure to gold in the form of Barrick Gold. So Barrick Gold's a gold mining stock. That was followed by overseas investments in Japanese companies with various businesses, including mining and energy. According to Jim Paulson, chief investment strategist at the Luthold Group, it looks like the Oracle of Omaha is preparing for high inflation as the dollar declines. Now, let's have a look at the dollar. So this is the DXY, or the Dixie Chicks, as some people call it. Now, back in March, we had that big spike up in the DXY, and then the DXY has pretty much fallen away since then. So everyone has been jumping on the bandwagon that the US dollar is in decline and will collapse. Some very smart people, like the Brent Johnsons of the world and Stephen Van Meters, they think there is going to be a rally up in the dollar, and we've certainly seen that in the DXY. So it's certainly rallied up. Now, I think if it can just trade sideways here for a little bit and prove that this little rally is real, then yeah, I could see the dollar, the DXY, taking a run up. How far? Well, time will tell. But if it doesn't, it's just a short-lived little thing, then yeah, down she goes. But even the Brent Johnsons of the world, even though they're dollar bullish moving forward, ultimately they do think that this is going to collapse, that the US dollar is going to collapse. But with global trade being in US dollars, that there is going to be demand for US dollars, especially as we start to open back up on the backside of this virus, and people will need dollars, and so there'll be a dollar shortage and a dollar squeeze. So, but ultimately, even they say that it will collapse. So, anyway, let's get back to the article. Here, Ray Dalio, the founder of hedge fund giant Bridgewater Associates, echoes Buffett's sentiments. It was reported earlier this month that Bridgewater Associates no longer considers conventional bonds a hedge against inflation. Bridgewater has tweaked its all-weather portfolio by dumping bonds and moving into gold. Meanwhile, billionaire Stanley Druckenmiller has also come forward to voice his concerns about inflation. And we did a previous video about Stanley on this, and I will link it in the description below if you haven't looked at it. It's only a short video, but yeah, Stanley Druckenmiller is definitely one of my all-time favorite investors. And so when these people are talking inflation and they're worried about this moving forward, you can't dismiss it. If you consider recent events, rapidly rising prices aren't very far away. For example, the US government was forced to bail out the entire population as a pandemic-induced shutdown caused massive job losses and bankruptcies. The coronavirus aid relief, or the CARES Act, alone adds $1.8 trillion to the deficit. In truth, this money was created out of thin air. The Federal Reserve funded this bill by buying government-issued bonds once again, the Fed had to resort to printing money, which it did recklessly. Well, yes and no. As I said before, ultimately the funds that are held, the reserves that are created, that are held at the Fed for the dealer banks, ultimately, the funds that the Fed do create out of thin air does ultimately get across to the TGA, the Treasury General Account, which the Treasury can then spend out into the real economy. So, in effect, yes, they are monetizing that debt, but legally they can't. So they kind of go through middlemen, i.e., dealer banks and so forth. So, but anyway, just got to throw that in there. It turned out the CARES Act wasn't enough, and there could be more stimulus on the way. Looks like Nancy Pelosi will go to all lengths to ensure more fiscal stimulus. We've seen debate over that, whether that's going to happen or not. As the Federal Reserve keeps buying government debt with printed currency, inflation will take off along with the national debt. As a result, asset prices will rise and the dollar will lose value. So, yes, they're buying precious metals and getting out of that typical 60-40 type investment portfolio. But let's have a look at so economist Stephen Roach issues new dollar crash warning, sees double dip recession, odds above 50%. Let's just have a quick look at this.
Convinced now than last June that the dollar is plunging? Obviously, it is lower now than where it was last June.
Well, when I first went out with this seemingly crazed idea, it was mainly theory. I argued three things: that the current account would get worse, that the euro would come back into favor, and that America has abdicated its global leadership role in the world. Those were ideas. But since then, what's happened is we've gotten data that's confirmed both the saving and the current account dynamic in a much more dramatic fashion than even I was looking for. So, I think the evidence is still very compelling. The euro started to improve a lot as well. And I can't say that America's done much of anything to improve its stature in the world community.
Let's talk about the odds of a double dip recession. You feel like this is more likely than not that we're going to see that. Talk about the reasons why.
Well, first of all, the record of history is pretty clear. In 8 of the last 11 business cycle recoveries, there's been a double dip where the GDP went up, then it went down, then it went up, and then it went down again. So it's certainly something that happens more often than not. 2 factors drive it. One, lingering vulnerability in the aftermath of the initial decline. We certainly have that in the U.S. with the unemployment rate remaining more than double its pre-COVID lows. And then second, the possibility of an aftershock. And as we head into flu season with the new infection rates moving back up again, with mortality unacceptably high, the risk of an aftershock is not something you can dismiss. So that's a tough combination. I think the record of history suggests that this is not a time, unlike what the frothy markets are doing, to bet that this is different.
So one of the assets that people would buy if they think there's going to be inflation, and Warren Buffett has once owned silver before, but silver is one particular asset that people would go to. Silver and gold are probably the most common. And silver actually, up until recently, has been the best performing asset in 2020. But you can see here that it is now entered a bear market territory, down 23%, although it has just stabilized above that 23. It's just jumped back up above $23 US an ounce at the time of this recording. So, what do people do? Do they jump off here? Why has silver fallen so much? Look, silver is more volatile than gold. Gold has also pulled back, but silver has always been more volatile than gold. But we've seen that the share markets have also fallen significantly. In fact, for the last 3 weeks in a row, they have fallen for the last 3 weeks. And so with that, when people get margin calls and whatnot, they need to sell things. And this is why we've seen a rise also in the dollar, I believe, is everyone is trying to sell whatever they've got to get their hands on dollars to cover their positions. So is it downwards from here for silver, or is this an opportunity to buy? Well, I'm not giving financial advice, and we don't give financial advice on this channel. This is just education, and we just chat and talk about things. And why would you listen to me? I don't know what I'm talking about. So but I am I like this asset. When you look at the silver to the currency supply, excuse me, the M2, when you look at this as a valuation method, is silver still cheap? If you look at the gold-silver ratio, that's now back up around 80, which is normally historically high. Back in March, it went well over 100 to reach its all-time high. Just recently, I've seen some reports that say that last year there was just under 800 million ounces of silver that were mined, that were produced, yet there was just over $1 billion, a billion ounces of silver that was in demand. Yes, most of that was for industrial purposes, but we do know that supply peaked in 2006 for silver, and supply has been going down ever since, and it's predicted to go down even further. And if the world keeps pushing towards a green energy with batteries and solar, electric vehicles and all this sort of thing, we know that the demand for silver is only going to go up. And if the supply numbers are true, accurate, well, just from a fundamental point of view, I like it. One of the other reasons why I like precious metals is I look at our economy. I look at the global debt to GDP ratio, which has hit all-time highs, and you can see it here. Right around the world, doesn't matter which country, everybody is just swimming in debt. And being a debt-based system, to grow, we need to keep growing and adding to the debt. And have we reached that point now where we're just with scarce resources, we can no longer keep growing that debt? That's the trick. And so I don't have confidence in that system. And one of the things that why people invest in gold and silver is not so much for inflation, but a lack of confidence in the system, a lack of confidence in the banking system, in central banks. You go back and look at charts throughout the 70s. Inflation kicked in the late 60s, right through the 70s, and really gold and silver really didn't spike up until the last couple of years in the 70s, where it really spiked up really quickly. Yet we had inflation before that. Now, it was because people lost confidence that the central bank could control it. And the same thing in 2011 as gold and silver went up. than when central banks were doing quantitative easing. Yes, maybe people thought there was going to be CPI increases, and there wasn't. But people lost confidence in the central banks then. So it's also a confidence issue in the system, and I certainly have confidence issues here. When I look at the bond market, any type of bond market, you want to go, government bonds, corporate bonds, whatever. Once upon a time, you used to buy bonds as a safe investment where you'd get your capital back and you'd earn a nice little interest rate. You'd get a nice return. Well, bonds just don't do that anymore. Bonds have become a speculative investment class where, a bond might be returning a 0% yield, but if investors think that central banks are going to continue to buy more and more bonds and push those yields into negative territory, then that pushes the price of those bonds up. And so we now have, the bond market's kind of become a speculative type market where people buy bonds simply to sell it at a higher price to get a capital gain out of it. And that's not really what bonds were really meant to represent. And just with this, I mean, we see the corporate debt to GDP levels just skyrocketing as yields go down. I don't know how this ends well. I don't know how they unwind this. And, the question is, what do we replace these bonds with? With debt this high, bonds must now be replaced by ever-increasing rates of US dollar depreciation, or else the financial system will collapse chaotically. And, so I've lost faith, and that's why I like to be in something like gold and silver, physical gold and silver, where there's no counterparty risk. It's something that's real. And we'll look at the stock markets. On any value metrics, they don't represent the real economy. There's been a disconnect there. But look at the flows in, and now look at the flows out of the market. So we're starting to see flows coming out of the market here, and that's why we're seeing basically a sell-off in the share markets. But we've, as I mentioned before, about liquidity, that's also had an impact in precious metals as well. But you can see here, once again, the fund flows. This is flows out of the market. Active and passive funds are flowing out of the market. As I mentioned before, from a fundamental point of view, the Nasdaq just continued to go up while earnings didn't, and there's that disconnect between that, and that's, to me, that's bubble territory. The S&P 500 return on equity, you can see that's going in absolute opposite directions. So for me, it's not real. It's a fake market. And for my Aussie followers here, I thought this was a very interesting chart. So this is the Aussie dollar and the S&P 500 index. And since March, in fact, I've gone back and had a look. It's weird. It kind of tracks the S&P 500 index. Now, this chart, you can see the dollar there is at just under 73 cents. So you can see that it's kind of the S&P 500 as it's fallen. There's been a little breakaway from that. But what's happened, folks? What's happened to the Aussie dollar? Well, let's have a look at that. So, well, first here's the S&P 500. So you can see, the .com bubble, the real estate bubble, and I think that picture just speaks for itself. I don't think that needs me to add anything more to that. Look at the Dow Jones, same thing. I think that picture speaks for itself. Look at the NASDAQ. So we had the dot-com bubble here. The NASDAQ didn't really bubble up back there, did it? And then pretty much come March, one direction. However, we can see that rolling over. But going back to our Aussie dollar, and here you can see that the Aussie dollar has now rolled over, and it's just holding on to 70 US cents there. So that chart is quite interesting. It tracks that the S&P 500. I've only just come across this recently, so this is something new for me. So obviously the Aussie dollar really follows what happens in the US there. But so is there going to be inflation? All the smart investors seem to think there is. I have my theories on it, and perhaps I'll share that in another video. I won't go through this article from the Mises Institute. This is a extract out of Ludwig von Mises' book, Interventionism, which you can see there, and I'll link in the description. You can read this because it's really important to understand what is inflation. I'll also put a link in there to an interview just recently done by John Williams from Shadow Stats, who tracks inflation, or the CPI numbers, how they were measured in the 70s, 80s, and 90s. Because the way we track them today isn't the same way. So you can't compare today's CPI numbers with the CPI numbers from the 70s and 80s, for example. So, and that might, you might be quite surprised to see what he's got to say in that piece there. So, once again, do we think there's going to be inflation, deflation? Well, I'm certainly hedging my bets. I think if we see a tremendous amount of defaults and bankruptcies and currency being destroyed, obviously that's deflationary, and that's definitely going to hit asset prices. However, with that, as businesses go out of business, there's less goods and services being produced. If we move away from globalization, that's inflationary as well, because globalization has always been known as deflationary. And if governments continue to do large deficit spendings and pump funds directly into the back pockets of households, chasing less goods and services, because there will be less goods and services, then I believe that we are going to see higher CPI numbers. But I do believe that the debt bubble that we've got in asset prices, unfortunately or fortunately, is going to have its day in the sun. So just be careful out there when you are investing your hard-earned dollars and managing your assets. It is a really tricky time, but hopefully you get some information out of this channel. And thanks for joining me today, and I look forward to seeing you next time on another episode of Finance Uncut.